The main event appears to be not maybe the geopolitics, but maybe actually what we get from Powell Friday. Walk us through the market reaction if Powell is hawkish or dovish.
So I think that Jackson Hole does actually matter this year. It's frequently anticlimactic, and I'm not saying it's going to be a big hyped up event, but it will be a trade next week. And the reason it appeals to me is I think that there's one trade that works no matter what the outcome. That's always a dangerous assumption to have, but let me walk you through the logic. I think that long end US bonds sell off, or at least struggle to rally no matter what, and most likely weaken no matter what happens. So first of all, the situation going to Jackson Hole is we've got aggressive cuts priced, despite the fact that inflation is well above target and rising, despite the fact that retail sales are still strong, consumers still spending, despite the fact that US stocks are at the highs, despite the fact that unemployment is not going up. Now, we've got a supply side problem on the labour market, which is why the clearly cooling labour market is not seeing a higher unemployment rate. But you don't cut rates to ease the supply problem. And also, orthodox central banking says that if you've got an inflation problem, inflation above target and rising, then you don't cut prematurely. You don't do an insurance cut. You wait till the economy clearly slows down. You maybe get a small recession, but that is a better response than cutting preemptively and stirring up inflation to risking cutting too early. So therefore, we've got too many cuts priced into the curve because of the administration pressure. So there are two outcomes. One is Powell, suddenly validates all this pressure. And that means it'll seem like, okay, the Fed is folding to the administration pressure. And that means an aggressive steepening of the curve. So you'll get probably a twist steepening. You'll get the front end lower and you'll get long end yields higher. The flip side is Powell reiterates that, hey, look, these rate cut pricing is bonkers. There's nothing to say that rates are restrictive just yet. And that means you actually get a shift higher in the yield curve. And long end yields will be under pressure yet again. And that will just double down Trump pressure, which will again increase the dynamic of steepening. So I think long end yields are skewed to go higher no matter what happens out of Jackson Hole.
I guess, Mark, the other option could be is that he tries to sound as market neutral as possible. I mean, do you think that Jay Powell likes the September Fed pricing as it is, an 85% chance of that cut, or does he want to pare that back before this next round of data?
That's a great question. I actually don't think he minds the pricing right now. Remember, again, there's a not unreasonable chance the Fed has to cut super aggressively. It is clear the economy is slowing. It's clear the labor market's slowing. It's just that in this situation, with inflation a much bigger problem, it is not the time when the Fed should cut early. So they need to make sure that the economy is going off the cliff and then cut really aggressively. This is why in this scenario of high inflation, you don't get a cycle of rate cuts. You get no rate cuts, and then you're going to get 150 basis points in the space of a couple of meetings when we realize that we really need to cut rates really aggressively. But until then, there won't be any rate cuts. Right now, he shouldn't push back on the cuts that are priced in the market.
Mark, okay, so let's stick with the idea that potentially there is a hawkish outcome here. How vulnerable is the Mag 7 to that, given the long duration nature of that asset?
Yeah, I think Mag 7 AI is acutely vulnerable right now. And I need to put the context here that while I have long kind of thought that US stocks are overvalued relative to the rest of the world, I have not been someone who's been specifically negative on AI. In fact, I'm normally quite constructive on AI. I've just thought the valuation premium in the US is wrong. With that context, I am now finally, after a couple of years, worried about the AI theme specifically. And that's because the incredible amount of capex that we've seen gone in. Sam Altman just said it was crazy while saying he expects to spend trillions. And he even said it's overinvestment out there. And that, it's the OpenAI CEO at the center of this. So because of all that capex, they are much higher duration assets than they were before. So they're much more vulnerable to higher interest rates. So I think that's one dynamic. Jackson Hole threatens them in the coming couple of weeks. Also, we're soon set to get the tariffs on chips, which might be a risk for the sector. We're also seeing Trump getting encouraged by the fact that so far it doesn't seem like there'll be a legal challenge to the NVIDIA AMD revenue share that he's getting. So he said last week, the White House said that they might expand it to other companies, which is a direct hit to profit margins. So I think there's several dynamics that are coming up at once against AI that makes them vulnerable. Now, we do have NVIDIA earnings at the end of the month. They are likely to be very positive. The evidence from this earnings season, which we know, is that the AI boom has been going strong. But I think that's backward looking. I think that bears will want to wait till that gets out of the way. So I think it's probably after that that I think AI is acutely vulnerable. But we really now I'm getting worried for the next month for that AI sector, and that means all global markets.